Bob, I watched your presentation here at the Goldman Sachs conference, and you seem pretty positive. I mean, here's some quotes. I'll read you back to you.
All right.
Ad weakness has been overplayed.
Yeah.
The economy will right itself much sooner than people think. Q3 is going to finish strong. The trend is good. So what's the stock market getting wrong here?
Well, look, there are a bunch of things, and those comments will have different metrics in them. But on the market getting better sooner than people think, look, I just looked at history, and we talk about we're in a recession, et cetera, and definition of recession is 2 quarters negative growth, so that's Q1 and Q2. That's a fact.
It may be, although there's plenty of debate about what
a lot
really
of debate
means
about,
a
but
recession,
historically,
given where we are in employment numbers. But anyway.
Yeah, but historically, that was definition of recession.
Yes.
And historically, if you look at post-World War II, I believe the statistic is the average recession lasted 9 months. So I'm not saying the world is as it was in history, but the notion of 23 is doom and gloom, which is out there, I think it's overplayed. So that's what I mean by the ad market weakness is overplayed. Certainly for us, we're seeing a positive trend line in the year. Q2 is better than Q1, Q3 is better than Q2, and Q4 will be better than Q3. So that's encouraging. That's a function of the share gains, particularly at the CBS Broadcast Network. It's a function of the upfront we laid, which was really a volume upfront. We sold significantly more inventory, so we're not that dependent on scatter. And it's a function of specific categories, obviously political, which will be very strong in the back half of this year, but also pharma, which is a big category for us coming back. So there's some real underlying metrics, and then there's this notion of we're in a cycle. It's not a...
How does it compare to other cycles you've seen in your career in terms of, you weathered recessions before?
They all turn. I think the best example is the UK ad market, which tends to turn up or down faster than anywhere else, and I've seen that happen multiple times. I remember the post-September 11 market when the ad market turned really negative, and I remember as a result of that, we had pretty conservative budgets, and by the end of that next year, we blew the budget away because the market turned.
But I don't feel like right now people think that the market is as weak as they're worried it's going to become. You're not really seeing a particularly weak ad market right now, are you?
Correct. That's another part of the overblown. The market's actually pretty good. The digital programmatic side is weak, but the linear side is pretty good. But it's more, people are talking negative about the ad market. Valuations, metrics have come in. And people are talking about an extended slowdown, which again, I don't know, it's a prediction. But what I'm seeing, I'm feeling better about 23 than the general narrative.
Okay,
and your other question about Q3 and Q4?
I was picking different things to show that you were positive. You were talking more there, I think, about direct-to-consumer and just in terms
exactly.
of sub-growth.
You look at the D2C category, in particular for Paramount Plus, we're very happy with where Paramount Plus is. When we launched that product 18 months ago, there were a lot of questions about us being too late, et cetera. Fast forward to 2022, we led the market in terms of share and net ads in Q1, Q2, and Q3 to date, that based on antenna data. We didn't win every month, but we won the vast majority of them. And I look at going forward, this quarter we're in and the fourth quarter. This quarter, our content engine is back at scale, particularly in September. We got the NFL back. By the way, linear ratings up 20% for Game 1. And we set, which is best in 4 years, and we set a new record at Paramount Plus, so that's totally working. UEFA's back. Last season versus season, we're up 70+%. And then what you got is we just announced a new deal, actually executed with Walmart, which started a week ago, which is a real tailwind for subscribers.
Right.
And is already performing better than we at least had in our plans. So very happy with that.
Can you give us a sense what you had in your plans and how it's performing better?
It's early days for us to give out numbers, but it's really proving to be a significant source of new subscribers. And so Q3 will finish strong for us. And then I look at Q4, and I look at our content pipeline. Obviously, the CBS fall schedule continues. That's a real source of subscribers and engagement for Paramount Plus. You look at what's coming in terms of originals. I'm particularly excited about Taylor Sheridan's show, the one with Sly Stallone, Tulsa King. I've seen it. It's awesome. It's basically Sylvester Stallone playing Tony Soprano, taking over Tulsa. It's great. And then we got Harrison Ford is in 1923, which is the next iteration of Yellowstone. So tremendously excited.
And
we got Top Gun coming.
One. Yep,
I mean, Top Gun Maverick, the gift that keeps giving. The only movie in history that was #1 on Memorial Day and #1 on Labor Day. 5th biggest movie in all time. And look, it's going to crush it on Paramount Plus. So that's a strong finish to Q4. So we're feeling great.
Yeah, and I mean, and Churn is because sure, you come for whatever you come for, but the concern here with direct to consumer, and we've seen it obviously, is people churn off. They churn off after the NFL season. They churn off after they watch the big movie.
There's certainly churn. We've seen our churn metrics continue to improve in the last 18 months. And I think as we go forward and as we particularly get more consistent flow of original content, you look at July and August, for example, it wasn't that great. We still won on net subscriber adds, but we're seeing a re-acceleration in total subscribers in September and certainly in Q4. That's also a function of churn being good. So I think churn will continue to get better.
Right.
Because at the end of the day, it's a great service. News, sports, a mountain of entertainment. We believed in broad. And every time we take the next step, the thesis is proving out more and more correct.
Yeah, it sounds a lot like something I grew up with, which was called television. It had ads, it had news and sports and some entertainment.
Well, that's Paramount Plus. And I'm telling you, even news, as an example, doesn't bring in a lot of subscribers. But for engagement, there's a lot of news consumption on Paramount Plus.
But, all right, but what does that all mean for the linear TV business? I mean, you still own a bunch of cable networks that are pretty darn important to producing the free cash flow that you're relying on to pay for a lot of that content to power DTC.
We do, and they're still a good source of audience. They're a fantastic source of content, big libraries. You look at BET, I mean, we're very strong, particularly in the diverse audience segment. Look at BET, its linear ratings are up year to year, as is its revenue. I think 2 weeks ago, we did MTV Video Music Awards, an award show whose linear ratings were up year to year. Digital consumption was up year to year, which you would expect. But I think interestingly, the social engagement numbers, it's #1 ahead of the Super Bowl, ahead of the Academy Awards. So the cable business continues to fire on all cylinders for us. And then there's broadcast, CBS, the #1 network for the 14th straight year. We gained, I think, 18 share points this year, which is great.
I was wondering, you said 20 share points or roughly, and I was wondering what you were talking about. I thought ratings were down.
Share of broadcast audience, CBS up 18 points year to year. Broadcast season to broadcast season.
Right.
So the network's firing on all cylinders. The slate's really working. Obviously, the sports lineup's really working.
I'll tell you something that's not working.
What's not working?
Stock price.
Equity markets are rough. The whole media sector is caught in this negative ad sentiment and concerns about streaming profitability.
Yeah.
We talked about ad sentiment already. I think it's overplayed. And by the way, as that ad market comes back, our position delivering reach for advertisers, because if you want to be in the U.S. ad business, you better have a broadcast network, cable properties fine, and a fast network, fast, free ad-supported streaming television. We have the #1 service in Pluto TV, continues to grow like a weed. We've talked about it in the past.
Yes, we
so
have.
That's a reach solution for advertisers. We provide them access turnkey.
What do you think gives investors the most pause then? Is it just the continued spending on direct to consumer? I mean, next year, you've said many times, is going to be your peak investment year, and then we're going to all start talking about profitability.
Right.
Is that what they want to see it before they believe it?
Look, well, that's the second point, is D2C. I think the enemy of the market is uncertainty. Always has been. That's what people say. Clearly, there's uncertainty in the ad market, and there's uncertainty in D2C. When are you going to be profitable? Is this going to be as good a business as traditional TV, et cetera? And as time plays out, I think we'll prove the ad business, once again, is a great business, and we are positioned to lead that business based on our portfolio of assets and our execution. And the D2C side, we're going to prove to the world that Paramount Plus is a cornerstone service. Again, in 18 months, it's come much further than anyone expected. We're rolling it around the world. We're going to be in all of Western Europe by the end of the year. We're launching in Italy tomorrow, by the way.
Okay.
So we're building real scale there. And yes, we very much have path to profitability and a real business. And
you did talk about price going up. I mean, you said we'll tuck in behind Disney and others. You should assume price will go up. When do you start raising price, and how do you know when the right time is?
Well, the first point is I think people underestimate the impact of pricing on D2C. It's a part of the problem with profitability in the space is pricing is currently low. That's true for Paramount Plus. It's true for Disney Plus, whatever. What they miss is that price is going to go up over time. And sure, we'll be careful about when we raise price. We probably let some other people raise price first. We'll time it to when our content lineup is particularly strong. We'll probably raise our premium service before we raise the price on our lower price ad tier so we can catch any downturn. But there's no question that price is going to grow over time because these are extraordinary values for consumers. And once a family finds Paramount Plus and the kids library, for example, I dare you to go cancel that. Your kids would freak out. So there's pricing power here.
Maybe out of the demographic.
Well, maybe they're kids, but you know what I'm saying.
But I might freak out. You know, I mean, I like it.
You need to fix a SpongeBob now and then,
Kid,
right?
You can't get enough SpongeBob, no matter how old you are, Bob. You know that.
I'm with you.
Yeah, but average revenue per user you don't give us. We don't know what ARPU is for the overall service. Is that something you'll provide us at some point so we can see whether you really are raising price actually across the board?
A couple things. One is we have progressively increased our disclosure over time. We started with some just sub numbers. This year we moved to a D2C segment versus TV media versus filmed entertainment. So investors could get visibility into the whole P&L. As we continue our journey forward, there's no question we're going to release more metrics. Right now people calculate ARPU based on certain estimates. But yeah, that'll definitely tick up over time, and that's a function of both what's going on the subscriber pricing side as well as on the advertising side. Because remember, we were essentially the first to believe in ad-supported streaming with Pluto TV. And then when we launched Paramount Plus, we said we will have a lower-priced ad-supported tier.
You're what, $4.99? What's the ad load per hour usually for you guys?
It varies. It's still light relative to traditional TV.
Right.
But it's driving ARPU, and we're seeing very nice growth even in the current market on Paramount Plus.
And even with the Walmart deal itself, which I know we're not going to know specifics of, but there as well. I mean, in other words, whatever the overall cost is that Walmart's paying for their subscribers.
And they very much are paying per subscriber. This is not some promotion deal.
Okay.
If you're a Walmart Plus subscriber, you're given the opportunity to get Paramount Plus. You do have to opt into it.
Right.
Then you become a Paramount Plus subscriber. You'll count as a subscriber, and we will get paid for that subscriber.
Okay. And as you said, it's going to help Q3 and potentially at least doing better than you'd anticipated early on.
It's going to be an incremental driver of our service, and I think equally important, I won't say more important, it's another good housekeeping seal of approval.
Right.
I mean, they could have been in business with anyone, and we know factually they were talking to other people, and at the end of the day, chose Paramount Plus.